There may be another downgrade coming for the banking industry. Fitch is warning it may be forced to cut the credit rating of dozens of banks, including big ones like JPMorgan. CNBC.com's Hugh Son was first to report the story. He joins us now, Hugh. So what's behind this potential move?
Hey, Mike. So I think just a little bit of context here. So Fitch, back in June, lowered its assessment of the U.S. banking industry's health from AA to AA minus. And there were no rating changes on the bank, so it went largely unnoticed. I think Fitch was actually kind of concerned at the increasing risk that they'd have to cut it another notch. So taking that industry rating from AA minus to A plus, which is one level lower. Now, the problem that introduces, Mike, is that you have four institutions, some of our top-rated credits, including JPMorgan and Bank of America, the two biggest banks in the country, that are rated currently AA minus. And you can't have banks rated higher than the operating environment in which they operate. So that would necessitate at least the examination of cutting them from AA minus to A plus. And that would potentially set off a cascade of examinations of the entire universe of banks covered by Fitch. There are more than 70, where you would have to consider cutting some of these other banks, that are rated less than JPMorgan and B of A to maintain the gap between the top banks and the lesser credits, Mike.
I suppose that this is still based on a lot of the issues that we are, have been aware of for months, which is, higher cost of deposits, some deposit flight, taking some unrealized losses on bonds, maybe some deterioration of the economy down the road. I guess the big question for me is, this will matter if it does raise the cost of borrowing for the institutions. Of course, debt and deposits are the raw material for what banks produce, right? So is there any evidence that might be the case?
Well, I think, you would have, obviously the markets are a dynamic thing. I mean, Moody's, cut 10 banks last week, and Morgan Stanley analysts basically pointed out they believe that the borrowing costs for the downgraded banks would increase, and there's even a risk that some of the banks could get locked out of debt markets overall. If you increase the cost of debt issuance, what does that do? That basically increases the pressure on their profit margins, and that's one of the big stories, of the year. I think it's important to point out two things. The reasons, the factors that would potentially push Fitch to do this would be, credit normalization. If commercial credit, obviously we're talking about office loans, if it's worse than they expect, if that normalization is actually worse than they expect, then they would have to look at that. And if the Fed actually has to keep rates higher for longer, then that's something that they would have to look at as a trigger for these potential downgrades.
Yeah, normalization in this case is a negative because we're coming off of such a low credit loss environment. I suppose, the idea of the potential for higher borrowing costs for banks in aggregate is sort of interesting, given the fact that regulators are now floating these ideas that smaller banks should rely more on long-term debt. In other words, raise a lot more long-term debt as a capital cushion so that they have it locked up.
Right. And, you're running into the possibility that, the market it doesn't have a great appetite for some of these lower rated credits. I think the interesting thing for my money, Mike, is that, the downgrades from last week were largely small and mid-sized banks. We're talking about JPMorgan and Bank of America here, State Street, Boney Mellon, the top-rated credits in the country, potentially going down a rung, and the cascade effect that would have.
Yeah, it would be an interesting test of the market's view of those issuers. So we'll have to see how that plays out. Hugh, thanks very much. And you can read Hugh's full story on CNBC.com.